18 months. That is how long you have to move your money before the next big shift hits. Not 2 years, not 6 months, 18 months. I have studied debt cycles for over 50 years. I called the 2008 crash. I warned about the dollar losing its strength back in 2014. And right now, every signal I track is flashing red at the same time. We are in stage 7 of an 8-stage long-term debt cycle. The final stage wipes out 50 to 60% of most normal portfolios, but it does not have to wipe out yours. There are 4 types of investments that survive what is coming. Only 4. And in the next 25 minutes, I am going to show you exactly what they are, why they work, and how to own them before that window closes for good. These big shifts happen every 75 to 100 years. The last one was in the 1930s. They do not end quietly. They end with a massive move of wealth from people who own the wrong things to people who own the right things. Here is what nobody is telling you right now. The news will not say it. Your financial advisor will not say it. And the big banks definitely will not say it. But the math is right there in front of us. The United States owes over 34 trillion. That number goes up by about 1 trillion every 100 days. The interest we pay on that debt just crossed 1 trillion a year. That means we now pay more in interest than we spend on the entire military. Think about that. We spend more just paying the interest bill than we spend protecting the country. That is not a political opinion. That is just arithmetic. And when a country hits that point in the debt cycle, history tells us exactly what comes next. Most people will keep doing what they are doing. They will stay in their 401k target date funds. They will listen to their advisor who gets paid when they stay put. They will watch the news and feel confused. And then one day they will wake up and their savings will be worth 40% less. Not because the number went down, but because every dollar they saved quietly lost its buying power while they were not paying attention. That is the trick. That is how it always works. And that is why we are here today. Let me tell you about a man named Richard. Richard is 54 years old. He spent 28 years as a mechanical engineer at a manufacturing company in Ohio. He was not flashy. He did not buy fancy things. He just showed up, worked hard, and saved. By the time he turned 52, he had built up $1.8 million in retirement savings. His financial advisor put him in a classic 60-40 portfolio. That means 60% in stocks and 40% in bonds. His advisor told him this was the safe, smart, proven approach. His advisor showed him charts going back 40 years. The charts looked great. Richard trusted the math. He trusted the charts. He trusted his advisor. I want you to know something about those charts. They were built on a 40-year period when interest rates kept going down. When rates go down, both stocks and bonds go up at the same time. That is why the 60-40 portfolio worked so well for so long. But here is the problem. Rates cannot go down from zero. When rates go back up, stocks and bonds fall at the same time. The one thing that was supposed to protect Richard hurt him just as much as the thing it was supposed to protect him from. In 2022, when rates rose fast, Richard watched his portfolio drop from $1.8 million to about $830,000. That is a loss of $970,000, almost $1 million, gone. Not because he did anything wrong, because he followed the advice that worked for 40 years but stopped working the moment the cycle turned. Richard now works part-time consulting. He cannot retire when he planned to. He moved out of his house in the suburbs and into a smaller apartment. His financial advisor retired to Palm Beach. The advisor kept his fee the whole time the portfolio was going down. The advisor played golf while Richard went back to work. Do not be Richard. The whole point of this video is so that you do not have to be Richard. Now let me show you why this is happening and why it is not an accident. There are 3 forces that drive every economy. The first force is productivity. This is just how good we are at making things and providing services. It grows slowly, about 1 to 2% a year. It is the real engine of long term wealth. It does not make the news very often because it is boring. The second force is the short term debt cycle. This runs about 5 to 8 years. When banks make it easy to borrow money, people borrow more and the economy grows. Then prices go up. Then the central bank raises rates to slow things down. Then we get a recession. Then rates go down again and the whole thing repeats. You have probably lived through 3 or 4 of these already. The recessions of 1990, 2001, 2008, and 2020. Those were all short term cycles. The third force is the long term debt cycle. This one runs 75 to 100 years. Most people never see it happen in their lifetime. It builds slowly over decades. Debt grows faster than income, then faster still. Then the whole system gets to a point where the debt is so big it cannot be paid back in a normal way. That is where we are right now. Total U.S. debt, including households, businesses, and the government, is over 95 trillion. The government alone owes 34 trillion. Our total debt is now about 30-60% of what the entire country produces in a year. That ratio has only been this high one other time in American history. That was in 1929, the year before the Great Depression started. Now, I am not saying a depression is coming tomorrow, but I am saying the math is not lying to us. And when the government owes this much, there are only 3 ways out. Option 1 is that the government stops paying. They call this a default. They just say we cannot pay back what we owe. This almost never happens with a country that prints its own money. It is too embarrassing. It causes immediate panic. Countries almost never choose this option because there is an easier one available. Option 2 is debt restructuring. This means the government goes to the people who own its debt and says, we will pay you back, but we need more time or we will pay you less than we promised. This is less embarrassing than a full stop, but it still shakes confidence in the dollar. It still hurts the people who saved in safe government bonds. This option also gets chosen less often because there is still an easier one. Option 3 is inflation. The central bank prints new money. They use that money to help the government pay its bills. The debt does not disappear, but the dollars used to pay it back are worth less than the dollars originally borrowed. Here is the math on that. Let us say the government borrowed 100,000 from you in 2020. By 2030, if inflation runs at 7% a year, the buying power of that 100,000 has been cut in half. The government pays you back 100,000. But those dollars can only buy what 50,000 could buy back in 2020. The government wins, you lose. This is not a theory. This is exactly what happened in the 1940s after World War II. The U.S. had massive debt from the war. Inflation ran between 8 and 14% for years. The real value of that debt melted away. Savers got crushed, but nobody officially declared a crisis. Nobody said they stopped paying. The money just slowly became worth less. And that is exactly the path we are on again. Which option will they choose this time? Same one they always choose. The one that is quiet. The one that does not look like a disaster while it is happening. The one where they print more money and let inflation do the work. If you are a saver, this is the worst option for you. And it is the one that is almost certainly coming. Let me take you back to the 1970s for a moment, because that decade taught us something important. Between 1966 and 1982, the stock market went exactly nowhere. 16 years of flat. If you put $100,000 in stocks in 1966, you still had roughly $100,000 in 1982. But because prices went up during those years, your real buying power had dropped by about 60%. Bonds were even worse. The bonds that were supposed to be safe lost more than 60% of their real value over that same period. But here is the other side of that story. Gold went from 35 an ounce in 1971 to 850 an ounce in 1980. That is a gain of more than 2,300%. Energy company revenues grew by over 700%. Certain kinds of real assets, things with real physical value, went way up while paper assets went sideways or down. The people who owned the right things during the 1970s did not just survive, they got rich. While their neighbors watched inflation eat their savings, these people were building wealth. The difference was not intelligence. It was not luck. It was knowing which assets work when governments print too much money and which ones do not. Now, let me tell you about Margaret. Margaret is 68. She was a school teacher for 35 years in Arizona. She raised two kids mostly on her own after her husband passed away. Her husband had been the one who followed the financial news. He had the spreadsheets. He had the plan. When he died from a heart attack at 63, a lot of that knowledge went with him. Margaret had about $1, $4 million saved between her pension and her 401k. She met with a financial planner at her local bank branch. That planner put her in a mix of growth funds and long-term government bonds. The bonds were supposed to be safe. They were not. When inflation hit hard in 2021 and 2022 and the central bank raised rates, her long-term bond funds dropped by more than 30%. Her growth funds dropped by another 25%. In 2 years, her $1 $4 million shrank to about $800,000. She called her planner. He said, "Stay the course." He said it will come back. She asked him what she should do if it did not come back before she needed the money. He said he was confident it would. She told me later, and I want you to hear this, she said. I wish someone had told me this in 2019. I had no idea that safe bonds could lose that much money. I thought safe meant safe. She is 68. She cannot wait 10 years for it to maybe come back. She is eating into her principal now every single month. She is spending what was supposed to last her 25 years in what may only last her 12. Margaret is a real person. Her story is not unusual. Millions of people her age are in the exact same situation right now. Do not let this be you. And if you have a parent or a grandparent or a neighbor in their 60s, please share this with them. They deserve to know this information before it is too late for them. So what do you actually do with your money? Here are the 4 buckets. These are not 4 random ideas. These are the 4 categories of assets that have protected wealth through every major economic reset in the last 100 years. Every single one. I am going to give you the name, the reason it works, the math on how much to put in each one, specific ways to buy it, and the honest downside. Bucket 1 is physical gold and silver. This is not a recommendation to get rich. This is a recommendation to not get poor. Gold does one thing very well. When governments print too much money and the dollar loses value, gold holds its value relative to almost everything else. It has done this for thousands of years. During the 1970s, gold went from 35 to 850. During the 2008 to 2011 period, gold went from about 800 to 1,900. During the COVID money printing period from 2020 to 2023, gold went from 1,000 to over 2,000. Every time the government has a debt problem and prints money to solve it, gold tends to go up in dollar terms. That is not a coincidence. That is the mechanism. Gold does not create value. It just reflects how many dollars it takes to buy the same real thing. Of every $100 you have, you should have about 15 to 20 in gold and silver. So if you have 500,000, that is 75,000 to 100,000 in physical precious metals. How do you buy it? You can buy physical gold coins or bars from reputable dealers. The American Gold Eagle and the Canadian Maple Leaf are both widely recognized. You can also buy gold through an ETF. The 2 biggest ones are GLD and IAU. If you want silver exposure, you can use SLV. The honest downside of gold is that it pays no income. You will not get dividends. Gold can also stay flat for years at a time. If stocks are booming and the dollar is strong, gold often goes nowhere. This bucket is not about growth, it is about protection. Bucket 2 is businesses that have pricing power. Let me explain what that phrase means. A business with pricing power can raise its prices when costs go up and customers will still keep buying from them. Think about a company that makes a product you need no matter what it costs. Think about a water utility. Think about a company that makes medicines people cannot live without. Think about a consumer goods company that makes the exact brand of product millions of people have used for 30 years and will not switch away from. When inflation hits, these companies pass the higher costs on to you and me. Their profits actually hold up or even go up during inflation. Their stock prices usually hold up too. The 1970s gave us a perfect test of this. Consumer staples companies and energy companies with real assets in the ground massively outperformed regular growth stocks during that period. Of every $100 you have saved, about 25 to 30 should be in this bucket. So on 500,000, that is 125,000 to 150,000. How do you buy it? You can buy individual dividend-paying stocks in sectors like consumer staples, energy, healthcare, and utilities. Or you can buy ETFs that focus on these categories. The Invesco Dividend Achievers ETF, ticker PFM, focuses on companies that have raised their dividends for at least 10 years in a row. The Vanguard Dividend Appreciation ETF, ticker VIG, does something similar. The honest downside here is that these companies tend to underperform in a fast-growing bull market. If tech stocks are flying up 30% a year, these boring dividend stocks might only go up 8 or 10%. You will feel like you are missing out. That feeling is the cost of protection. Bucket 3 is short-term U.S. Treasury bills and cash. I want to be very specific about the word short-term. I am not talking about 10-year or 30-year bonds. I said 90-day or 1-year Treasury bills. Here is the difference. A 30-year bond is a promise that the government will pay you a fixed rate for 30 years. If inflation rises and interest rates go up, the value of that bond goes down because now new bonds pay more. A 30-year bond is like lending your money at a fixed price in a world where prices keep changing. Long-term bonds can lose 30, 40, even 50% of their value when rates rise quickly. We saw this in 2022. That is what hurt Margaret. But a 90-day Treasury bill only locks up your money for 90 days. When those 90 days end, you roll over into a new bill at whatever the current rate is. You always stay current. You never get stuck. Right now, short-term treasuries are paying around 5%. That is real money. That is better than most savings accounts. And your principal is protected because you are always buying short-duration instruments. Of every $100, about 20 to 25 should be in this bucket. On a 500,000 to 100,000 to 125,000, how do you buy it? You can go directly to Treasury Direct, Gov, and buy T-bills yourself with no middleman. You can also use ETFs. The easiest one is SGOV, which is the iShares 0 to 3 month Treasury bill ETF. It automatically rolls your investment into new short-term bills every few weeks. The honest downside here is that this bucket will likely underperform stocks in a normal growing economy. You are not here to get rich with this bucket. You are here to not lose money while the storm blows through. Bucket 4 is real productive assets. This means things that produce real output in the real world. Things like farmland that grows food, real estate that houses businesses or people, infrastructure that moves energy or water. These assets have two properties that protect you in inflationary times. First, they often go up in price when the dollar goes down because they are real physical things. Second, they generate income. A farm produces crops. A warehouse generates rent. An energy pipeline charges fees. That income tends to rise with inflation over time. Real assets gave investors a major advantage in the 1970s, and they have done it every other time inflation got out of control. Of every $100 you have, about 20 to 25 should go here. How do you buy it? If you can buy actual farmland, that is the purest form. But most of us cannot afford to just buy a farm. Instead, you can use REITs. That stands for Real Estate Investment Trust. A REIT pools money from many investors and buys properties. You get a share of the income. The Vanguard Real Estate ETF, ticker VNQ, gives you broad exposure to commercial and residential real estate across the country. For farmland specifically, there is a publicly traded REIT called Farmland Partners, ticker FPI. For infrastructure and energy assets, you can look at the Global XMLP and Energy Infrastructure ETF, ticker MLPA. The honest downside of real assets is that they can be illiquid. REITs can also drop in price short term when interest rates rise because investors compare their yield to treasury yields. In 2022, many REITs dropped 20 to 30% even though the underlying properties held their value. You need to be comfortable holding through those short term drops. Now, let me give you the actual step-by-step plan, not just ideas, a real plan you can follow starting this week. Step 1 is to figure out your real timeline. How many years until you actually need to spend this money? This is the most important number in your plan. If you are 54 and you plan to retire at 65, you have 11 years. If you are 62 and you need income now, you have almost no runway. Your timeline determines how aggressive or conservative each bucket needs to be. Write down the number. 11 years, or 7 years, or 3 years. Write it on a piece of paper right now. That number is the foundation of everything else. Step 2 is to sell the garbage first. Before you build the 4 buckets, you need to clean out the things that are most exposed to what is coming. What is garbage in this context? Meme stocks that have no real earnings. Cryptocurrency positions that are bigger than 5% of your portfolio. Technology growth stocks that still have price to earnings ratios above 80 or 100. Long-term government bonds with maturities over 10 years. These are the things that will get hit hardest when the debt cycle moves into its final stage. Selling them does not mean you are giving up on growth forever. It means you are taking your chips off the most dangerous squares before the wheel spins. You do not have to sell everything at once, but you need to start. Pick the one position that you know in your heart is the most risky. Sell that one first. This month, not next quarter, this month. Step 3 is to build the 4 buckets over 6 months. Do not try to do everything at once. The market is unpredictable week to week. Spread your moves across 6 months. Month 1, open a Treasury Direct Gov account and buy your first T-bill. This is free. It takes about 20 minutes. Put in whatever amount feels right from your bucket 3 target. Month 2, buy your first position in a dividend-focused ETF like VIG or PFM. Month 3, buy your first gold position, either physical coins from a reputable dealer or the IAU ETF. Month 4, start building your real asset exposure through VNQ or a similar REIT ETF. Months 5 and 6, rebalance and add to whichever buckets are still underweight compared to your targets. By the end of month 6, you should be close to the target allocation across all 4 buckets. You do not have to be perfect. Getting to 80% of the target is far better than doing nothing while you wait for the perfect moment that never comes. Step 4 is to ignore the noise starting today. This one sounds easy and it is actually the hardest. In the next 18 months, you are going to see scary headlines. You are going to see markets bounce up and make you feel like you sold too early. You are going to see your old tech stocks go up 20% in a week, and you will feel sick about having sold them. You are going to hear people at work talking about the incredible returns they are getting in things you no longer own. This is where most people fail. They see the noise, they feel the fear of missing out. They abandon the plan. And then when the real drop comes, they are right back in the wrong assets at exactly the wrong moment. The plan I just gave you is built for a specific set of conditions. Those conditions are playing out right now. Stay in the plan. Ignore the noise. Review your allocations every 6 months. Make small adjustments. That is it. Here is something your advisor will not say to you. Most financial advisors get paid based on how much money you keep in accounts they manage. When you move money to a Treasury Direct account, they do not get paid on that. When you buy physical gold from a coin dealer, they do not get paid on that. Their income depends on you staying in the products they sell. That is not a personal attack on your advisor. Most of them are decent people who are doing what the system rewards them for. But you need to understand the incentive. The advice you receive is filtered through that incentive, whether anyone is aware of it or not. Your advisor will tell you to stay the course. They will show you charts of market recoveries. They will say no one can time the market. Some of that is even true, but it leaves out a crucial fact. In a long-term debt cycle reset, the markets do not always recover within a 10-year window. In Japan, the stock market peaked in 1989, and it took over 30 years to get back to that peak. 30 years. If you were 55 in 1989 in Japan and you were in a standard stock portfolio, you never saw a full recovery in your lifetime. This is not guaranteed to happen here, but the debt math in America today is worse than Japan's was in 1989. I am not saying panic, I am saying prepare. Most of you watching this will nod. You will feel the weight of what I just said. You will think about Richard. You will think about Margaret. You will mean to do something about it, and then life will happen. The kids will need something. Work will get busy. You will tell yourself you will start next month. Next month will become next quarter. Next quarter will become next year, and then the window will quietly close. The people who act in the next 90 days will look back on this period as the moment they protected everything they spent a lifetime building. The people who wait will look back on it too, but differently. Write down one number on a sticky note right now. The number is this: 18. That is the number of months you have to make these moves before the next phase of this cycle hits the markets in a way that changes everything. Tape that number to your bathroom mirror. Every morning when you see it, you will remember what you know. Every day that passes, you will know you are either closing in on the moves or running out of time to make them. In 12 months, you will either thank yourself for watching this today, or you will wish you had done something about it while you still could. That choice is yours right now. It has never been more clearly yours than it is at this moment. This is not about being the smartest person in the room. It is not about predicting exactly when the crash comes or what the exact trigger will be. You do not need to be right about the timing. You just need to own the right things when the shift happens. The 4 buckets work whether the crisis hits in 6 months or 24 months or 36 months. They work because they are built on real value, real things, real income, real assets, not on promises. Not on the continued expansion of a debt system that has run out of room to grow. The window is open right now. Use it.